Welcome everyone to our webcast. This is Connie Hill. I'm happy to have you joining me here. I've got a little problem that I didn't think I was going to have. So let me just change a setting here real quick. Webcast. This is Connie Hill. I'm happy to have you join. Account. Sitting in for Barb Armstrong. Barb is helping out at one of our workshops today and tomorrow. So hopefully you won't miss her too much. She'll be back next week. I am happy I am joined in the chat by Scott Thompson. He's here to maybe help answer some of your questions, things that maybe I can't quite get to. However, I have a couple of questions for you to start out with today, and I'd like you to chat the answer into the chat. Question number one is, how many of you pay attention to the beta of your stock? Okay, how many of you pay attention to the beta? And how many of you use ATR in your charts to help give you an idea? Does the stock move a lot? Does the stock move a little? We're going to focus on those two aspects today as we look at some different trades that might be appropriate for a smaller account. Now, I hope you're following me on X. I'm Connie Hill CS, and I'll post educational content out in my X account throughout the trading day as I see different things. All right. And I'm happy to see so many familiar faces here with us this morning. All right. Let's go through our disclosures and then we will take a look at our agenda. Options carry a high level of risk and are not suitable for all investors. What we talk about is for information and education only. We'll be using the Paper Money software application. That's what you download to your computer. It's the most robust version of Thinkorswim. Past performance is no guarantee of future results. A note on Paper Money, I think it's a great platform to practice these strategies that you're learning, okay, without putting you in any harm's way. Now, typically what we'll do in this class, look at the market overview and kind of see what that might be telling us as we're looking at different stocks that we might be interested in. Of course, we're going to do some new trades here today. Now, there's some premise for this class. There is the idea that this class we're managing a $20,000 Paper Money account. Now, your account may be totally different. Other part you're allocating that you're trying to build might be totally different numbers, okay? But in this class, due to that account size, we're going to say we're not going to spend $5,000 or more than $5,000 on any position. And usually we don't want to risk more than $400 to $500 per trade. So we're trying to keep that very small. To do so, we probably are going to focus on things maybe a little bit short to intermediate term types of trades. And we'll take both bullish and bearish positions. All right, now strategy-wise, if we're bullish, we will consider long stocks. We don't do a ton of long stocks in this class. We do a lot of option trades, but long calls, short puts, buy right covered calls, short put verticals, long call verticals. We are open to those strategies. And then on the bear side of things, we'll do some long puts. Long put verticals and short call verticals are definitely in the group of stocks. All right. So once in a while, we'll talk about iron condors and calendars. Probably not so much today in our class. Now, I'm going to go back and see how many of you are using ATR. How many of you are paying attention to beta? Looks like we have some mixed things here. Some of you saying you don't do it, or some of you are saying, yeah, I'm guilty of both, says Bob. I think that means looking at both. That's good. You should be guilty of that, Bob. David looks at the beta and sometimes the ATR. All right, so a lot of mixed results. David says, I've never used it on a chart. We won't use beta in a chart, but we will use the average true range of a stock. We'll talk about that. So very good. Appreciate your feedback there, and hopefully this will be something that you will learn that you can incorporate into kind of your trading, what you look at. Let's head over to Thinkorswim. I'm just going to start out on the SPX to give us a gauge of, what's going on in the marketplace. Now, this is a 3-month chart. Let's maybe go to a 6-month chart instead to give us a little bit more perspective here. It was in April, market peaked out and had a pretty significant slide back. right? People were talking about, oh, is the market in bearish territory? But you know, it recovered pretty quickly. It gave us this V bottom. If you look, it kind of looks like the letter V. Sometimes that is how we get rebounds. Sometimes we'll get what's called a U bottom. And on a U bottom, typically we have a little bit more price activity down here at the bottom. So like maybe it forms a basing pattern. Let's get that out of the way. And, you know, maybe we see it kind of more like this, and then it starts to go up. Okay, but it's fine. V patterns, not a bad thing at all. But at the last week or so, what have we seen here? I had kind of like a flagpole going up here, a flag coming back, but it really came back pretty close to the bottom of where that flagpole started. So we'd call that really a retracement as opposed to a flag, although it did break out of this, broke up here right above the 78.6 level on my Fibonacci retracement that I have going on there, which is a common area. And so it's kind of looks like that support area on the Fibonacci. The stock's honoring that. It's using that area of support. This might, because the market's not like moving up in great amounts right now, a little bit more sideways, people might not be quite as aggressive in some of their strategies. They may look to spreads like short put verticals, where maybe we're looking for a stock to stay above a certain point or below a certain point when we're looking at bearish type spreads. Now, let's come over and take a look at the NASDAQ. So right now, the SPX is down 0.3%. It's kind of been in that range all morning. If we look at the NDX here, we see kind of a similar story with a lot less lines on it. But just this idea that it's kind of been in a sideways pattern here. And so when we see that in the indexes, we typically are going to see a lot of it in different stocks. Now, it doesn't mean all the stocks are going to look that way, but it does mean that maybe that might persuade kind of what strategies we might consider pursuing here today. Let's just take a quick look at the VIX. Volatility gives us an idea of what volatility is in the market. High levels typically means skittish markets or downtrending markets, even getting into bearish markets. And so we had that little peak in April, but it's kind of settled down here into a range that I'm going to say it's not as low as it could go, right? We've been low like 10. This year, it's been more like 12 and 11 have been our lows. But, you know, it's sitting here about 19, and it's just kind of staying in that area, not really ramping up, not really dropping too much. Okay, we will use VIX, which is the put call ratio as far as the S&P 500 goes, and it's kind of the most common ticker symbol that we'll use there. Now, as we are looking at the volatility, well, actually, let's change this back to SPX. And I do want to talk about one thing that's on the screen right now, which is the average true range. Okay, that really just measures the last 14 trading days. What has been the high, what has been the low, and what's the average there? And then how we might use it is we could see here during this period of time when it looked like maybe the market was rebounding here, the average true range was going up. What does that mean? Kind of means look at these candles. Look how tall a lot of these candles are, which means we had a really big range as far as what they were doing. And then more recently in this little run up, and especially in this little consolidation, we're seeing the moves be a little bit smaller. Okay, we're seeing them, you know, come down here from say 200 at about 200 points a day right now. Maybe the range on the SPX is about 88 points. Okay, so definitely kind of moving down into an area where it's not moving around, not giving us huge ranges right now. Okay, that kind of goes into the idea that we may consider doing more neutral or slightly bullish, slightly bearish strategies. All right. Now the beta, we're going to talk about that as we look at some individual stocks. Let's just look at a couple here. And what I'm going to do is bring up the trade tab. And in the trade tab, I've got this area expanded, so it brings us a second row of information. And then what we're going to see is beta is right over here, right on this far side, okay? That is where our beta is. Now, a beta essentially is measuring the movement of a stock compared to a stock in the S&P 500. If it's average to the S&P, then it will be a value of 1 because the beta for SPX is always 1. And then we measure that, well, how volatile are you compared to SPX? So let's look at a couple of stocks that you're probably familiar with and just kind of see what their betas are. First, pull up here. Let's go with Google. Okay, pretty familiar with Google, all right. If we come over here, we look at its beta, it's a 1.08. So it is pretty close to what the SPX does, which means if the SPX were to move $1, what we're likely to see on average with Google, or what we have seen, because it's really measuring the last 5 years, is that maybe it moves $1 as well and 8 cents. So a little bit higher than the SPX, but kind of following it pretty closely. Let's look at Apple. You guys are pretty with Apple. Again, this beta that we're using, actually, let's look at this. Apple is a 1.2, but above that filter, right next to this filter, it says beta. Do you see that little icon? It looks kind of like a little lightning rod type of thing. Well, it's going to take us, I clicked on it, okay? It's going to take us to the setting for the beta. All right, now you can see over here, beta calculation. Right now it's standard, which means it's going over 5 years. However, suppose you've got some newer stocks that haven't been around 5 years and therefore they're not showing you a beta. If that is the case and you want to change it, this is what you would do. You would come down here and say fast beta, and then it's just going to look at that shorter period of time that it has available. All right, and it's going to be more, I'm going to say more like 1 year of looking at how much it moves compared to the SPX. So you can see on Apple, it changed it a little bit. The faster beta, it was saying it's a 1.13. Now, if you change it, like I just did, it's going to show up that way for all your stocks. Okay, so just know that there are those 2 different ways that you can measure beta. I'm going to turn this back. We're going to go back to the calculation. I'm just going to put it back on the standard because that's what we're going to use today. But I wanted you to be aware, if you're looking at some newer stocks, why they might not have a beta. All right, next stock, let's look at this one. You guys might be familiar with the stock. It's been a big mover recently, Carvana. What is its beta? 1.96. So the S&P 500 moves a point. Probably Carvana is going to move twice that amount. Okay, that will, what's that going to do to us? What are we going to notice? Well, we're going to notice that maybe there's some higher volatility priced into the options. Okay, something that's really low might be like in the 20s, maybe 25. Something that's maybe higher, like 35 or 40, we're going to say is more volatile, and we're seeing that representation in Carvana's options. Okay, and for fun, let's just look at Carvana. Let's look at its ATR, and you can see it kind of peaked up here, moving about 23 points a day on a $324 stock, or at that time it was actually around 200. And so as it's been going up here, that range, actually the candles are not as big as they were in this area. Okay, so smaller candles means lower ATR. But on Carvana right now, we'd say, okay, the average true range that Carvana is moving right now is about 13 points a day, from a high point to a low point. Okay, so dollar-wise, it's not too shabby, but it is a more expensive stock. All right, next up, let's do this. Let's take a look at something that has moved around a little bit. Okay, I'm going to show you, we're going to look at the setup, the technical setup here with HIMSS, but I'm going to come and bring you over here and look at the beta. 2, it's more with 2.14. So if the SPX were to move, say 1 point, expectation is that HIMSS would move in the area of about 2 points. So it is twice as volatile as the SPX. Now, again, look at implied volatility priced in the options. Oh my, those are high, which means they're expensive. It also means maybe we want to do a selling strategy and not a down and out buying strategy. All right. Hopefully you have a gauge for that now as we go into our discussion. So let's look at HIMSS from a technical perspective. Had some decent earnings, had a really nice pop on it, and then rallied up. Kind of got up to what, maybe about 65 or so. You know, if I were drawing in a resistance line, might end up about 56 or 65 rather. Okay. And support's down here about 52. Now, what we're seeing today is it looks like it's trying to bounce off that support. Looks like it's kind of been building a short base, not a huge base, but as the SPX has kind of been going a little bit sideways, looks like the stock here as well has been going a little bit sideways, but looks like a decent move today. Now, on average, the last 14 days, it's moved around 4.5 points from the low to the high. Okay, so if it were to move, let's see, today so far, let's see what it is today. Today's range is 4.16, so it's almost as high as that ATR so far today. Let's now look at what we might consider for a trade. Let's look at something here that might be a little bit different than what, maybe a little bit more aggressive. Instead of different, I'm going to use the term aggressive. A trade that's maybe a little bit more aggressive than what we could typically set up. Okay. Now we're still going to use the class rules. We're not going to risk more than $400 to $500 per trade. That's about the most we want to risk. Doesn't mean we really want to lose it. Okay. Now somebody could come in here and say, man, the implied volatility is really high, and therefore I want to be a seller. And so somebody might come over here and just really look at selling. And you can see the bid-ask spread here is fairly tight. I mean, I like this, $2.03 by 215. On the call side of things, you know, we've got 495 by 510. That's wonderful. We love to see that narrowness in the spread, and love to see, you know, thousands of contracts out here in open interest. Now, because HIMSS is a little bit more volatile, and perhaps we can get a little bit more movement out of it right now, instead of doing a total selling strategy, we're going to do a long call vertical, and we're actually going to do this a little bit aggressively. Okay, stock's at 56 right now, and so what we're going to do, let's see if this still makes sense. If we were just going to buy, let's do this. Let's do the 56. So we'll go at the money, which is going to be a little bit different than what I was initially thinking because the stock's moved a little bit more. 56, we're going to say buy vertical. And if we're going to be fairly conservative, then we might just say we're just going to do a $1 wide spread, right? For a smaller account, if you can spend 40 bucks on a trade, do a few contracts, that can be really helpful, right, as you're working with that smaller account. Now, what we're going to do is a little bit more aggressive. And what we're going to do, we're going to buy for our hedge leg the 60 strike. Okay, that's going to spread it out by $4. And actually, that started at 57. I really wanted 56. So let me change this to 56. Looks like I just kind of started on the wrong number. And we're going to change this to 60. Okay. So now what we're looking to do is we're looking for the stock, or the spread rather, it's going to cost us 158. Is that still within our risk tolerance? Absolutely. Yeah, we could do like 4 contracts here easily, maybe edging into 5, but we'll probably just stick with, say, 4. But what does that mean? We're going to risk, I'm going to kind of lock this in here. Okay, let's lock it in at 150. This will make our math a little bit easier. If we are willing to put out 150 and we want the stock to really do some moving, we're saying we want it to get beyond the 60 strike price. Let's see what that is on the chart. Okay, 60 is about right where my mouse is. Okay, that's going to require some movement in the stock. but it's kind of been in this little trading range between 65 and 52. That doesn't look like it's a terribly long, big move, but it is more aggressive as compared to if we just did a one strike difference and we were looking for it to go from 56 to 57. Okay, 57 is about right there. So that would definitely be looking for a more conservative trade. Okay, so whatever your approach is, just fine. This one I'm going to do a little bit more aggressive than we might typically do. If we're going to spend 150 on it and it's a $4 wide spread, what is our max theoretical gain? It's going to be $4 minus the 150 here, okay? So we are looking for 250, risk 150 to make 250. That's more aggressive, isn't it? If I say 250 divided by 150, that's about 166% return. So that's why I say, usually we don't try to hit really big home runs or setting up a trade that we're looking for a huge return. That's why this one's a little bit different. It might not be appropriate for everybody because it is definitely more risky. Okay. Now, if we're risking 250 per trade, then we're only going to be able to do how many contracts? We're going to be able to do 2. If we did the smaller spread, 56, 57, that number would be down lower, be 40 something, and therefore you could do more contracts. So you would gauge just depending on your particular risk parameters. Okay, let's go ahead here. Let's make it as a first trigger sequential, and let's put in our order to get out if we get a good chunk of that. Okay, say tomorrow, well, tomorrow's the weekend, so Friday is today. We've got a lot of the day left. Maybe it moves a little bit and then it moves into next week. Yeah, it could get up there to that 60 fairly quickly if it continues to move like it has, which is not really a guarantee. Okay, but we have a tendency to do some spreads in this class because it makes it easier to trade with a smaller account. All right, so we're taking our high beta stock, moves 4.5-ish points according to the ATR. Let's create an opposite order here. And what if we get a chunk of 250? What would you be happy with? That's going to be a different answer for everybody. But say we have 2.5, and what if we just said, it's an aggressive target. What if we just get 60% of it? Would we be happy with that? We might. Some people might not. Okay, but 60% of the 250 is basically $1.50. So we're going to say, we're going to take that $1.50, add it to the current net debit of $1.50, and we're going to say, all right, we want that spread to price out at $3. Okay, if it can go that far, great. That would give us about 100% return if we got out at that point. Okay, because we'd be risking 150 to make 150. So we're going to make this a GTC. We're going to just do those 2 contracts. We're going to hit confirm and send. And I'm going to put it in a bucket that we can track this on trading a smaller account. I might be here again. You never know. In fact, I'll be back on Monday. All right. So that's going to be trade number 1. All right. Let's take a look at something else. In our working orders, let's see. Okay, we'll see if it'll fill. It's wanting a little bit more money right now. We'll see if it waffles around a little bit and fills us. If it doesn't, I'll come back and adjust this working order. All right, next one up. You should hear with this stock as well. MO, Philip Morris. Okay, I'm going to let you see what the beta is. All right, as we talk about it, how it relates to its ATR. So on MO, we come over here to the beta. Wow, 0.66. So if the S&P 500 were to move a point, we'd expect MO to only move 66 points. Okay, 66 cents. So significantly smaller than our volatile HIMs, even though they're kind of similar prices right now. They're only like $3 or $4 apart. Now, as we look at the ATR here, it looks like this is moving about 95 cents from high to low. That's the range that it's trading in. So nothing super big, okay? And what have we got going on here today as far as a technical setup? Well, you can see I've drawn in a flagpole, got our little flag, and today looks like it's just breaking out of that flag pattern right now, okay? So what we could do here, we could, I'm going to kind of adjust this border over here. We're going to take our flagpole and duplicate it because that's the next expected move is about the amount on the flagpole. Now, or the distance. So we could put it back here towards the edge of the flagpole to create a target. This would put it up here about 62 and some change. Or if you want a more aggressive target, you could maybe place it here where we see the breakout. And that would give it a target up here more like, what, 63 and some change. So a little bit bigger. We're going to be a little bit more conservative here. We're going to go ahead and we're going to put this length that we expect it to travel to be a little bit shorter. And we're going to say here, that's giving us a target of about 62.28. All right. Now, are these options, would we expect them to be expensive? Well, with a lower beta, maybe not so much. And if I collapse, we can see the implied volatility here is really quite low, isn't it? Compared to what we just saw on HIMSS. It's up in the 80s and 90s. Yeah, this is in the 20s, which would say is in a lower range. And it makes sense because that beta is smaller. It's not going to move as much as a stock, an average stock on the S&P 500. So what kind of strategies would you consider here? All right. One, we could consider doing something more of a buying strategy because the implied volatility is lower. If we wanted to maybe go the length of that flagpole, we might come out here a little bit in time. We might come out to say the July options. You know, 20 to 40 days is kind of a sweet spot that some traders like for selling premium. When we're buying something, typically we want to make sure we buy enough time. Okay. And so what we're going to do here, let's see what we've got as far as strike prices go. Got a 57.50 that would definitely put it in the money. That's a 75 delta. Right now, this one is trading $2.50 down. And so if we look at the 62.50, that's way out of the money at a 24 delta. So kind of that sweet spot's going to be right there, pretty close to where the money is right there with a 50 delta. Okay, so we're going to go with this contract. Is it expensive? It's not. Does it have a lot of open interest? Oh, yeah, we love seeing the open interest. And then the bid-ask spread's only 7 cents. We love to see something really that narrow. That lets us know that there's a lot of liquidity there. There's a lot of trading action. And the stock doesn't have to move a ton, in this case, 6 or 7 cents, to be able to start moving into a position of potential profitability. Something has a really wide spread, man, we need that thing to move quite a bit. Okay. If we're going to risk 138 and we're willing to risk $500 per trade, let's divide 500 by $138. We can do 3 contracts. So that's what we're going to do. I'm going to put that there. Now, what I'd like to do is also put on an OCO order. Want to put in a place for us to get out if the target, we get near the target, or if we get lower, right? If it drops down on a flag pattern, if the candle drops into this flag consolidation area, we're going to say the pattern's broken. That also means you probably want to get out because we're getting in based on the fact that we think it's going to continue to go higher. Hopefully the length of that flagpole, although never guaranteed to be that much. Okay. So let's set this one up this way. Let's go. First triggers OCO right there. And we're going to create 2 opposite orders. And then we're going to configure those. Now, I'm noticing in the chat we've got a survey. So I'm going to pause here for just a moment. Let's talk about that survey. You guys know from time to time, we will have surveys out there. We want to kind of see what your thoughts are about this particular session. Now, we're not done, obviously. But maybe what you could do is just if you'll go select on that link, let it just sit in the background. And then when it's time for you to leave or our class wraps up, if you'll fill out that survey, it's an easy one. And I don't hesitate with easy surveys, right? You fill in the radio button twice on a scale of 1 to 10, just plop, plop. Then there's 2 questions that you can answer if you wanted to. And with that, you can use it to answer the question, or if you want to communicate something to me or something to Barb, since Barb typically teaches this class, I would share that information with her. Things that maybe you're struggling with, maybe something that would be helpful for you to see in an upcoming session, we would love to incorporate that into the class. Okay, so you can use that as real estate for that as well. Before we're done, we'll remind you about the survey again. All right. Now, what we're going to use is we're going to say on this stock for the targets, we're going to let it be based on the price of the stock. And so we don't really know what the price would be. So we're going to set that to a market order. We're going to go in and put in some conditions here. Okay, so this first condition, actually, there's a couple of ways I could have done this. We'll do it writing out both. This is not the most efficient way. But let's say if it gets greater than or equal to its target. Okay, now I wrote down 62.28 was the potential target area. And we could back off that a little bit. Let's go 62.18. Okay, so we're going to say if the stock gets up or beyond 62.18, so just kind of 10 cents lower, great. And then we're going to say, we're going to hit save. Now, if I thought through it a little bit before putting this in and creating the second order, we could actually put both conditions here. But because I did an OCO, we're going to put this in as a completely separate entity. And so what we need to look at here, if this thing drops and it goes down to, let's say, 58.80, and let's see what today's low was. Today's low is 59.50. So if it gets down in that 58.80 range, then we probably aren't that interested in it, because look how far it will have pulled back. If it kind of closes up here, then that's when we're saying that we probably want to be out. So let's go ahead. We're going to put that at 58.80. So we'll put our condition on here. Let's see. All right, this is saying it wants these to not be day orders, which is fine. We'll make them, we do actually want them to be GTCs. What it's saying right now is a regular market order should only be good for the day. I was planning on putting the GTCs on afterwards. There we go. But I guess it'll cooperate with us now. All right. Or if it gets less than or equal to, we're going to go 58.80, 58.8. And let's just make sure we've got our arrow going the right way. And we actually don't. I'm going to have to fix the other one. Okay. If the security is greater than or equal to 58.80, we actually want it to be less than or equal to. Okay, so we'll switch that around. We'll go ahead and hit save. And then let's just make sure this one is going the right direction here. Got to move that up. If it goes less than or equal to, actually we want it to be higher than. Okay, so let's switch that. All right, now it's going to be greater than or equal to. That's the way we want our arrows to go. So it's nice to be able to see that. And now it'll let us put on the good till cancel, because we don't know when that would happen, that condition. And, you know, maybe neither condition ever happens, but whichever one executes first, it'll go, meets that condition, it'll go and execute that. If it goes down to the stop, unfortunately, we don't like that, but we'll get ourselves out of the trade there based on what the stock does. All right. So this is our 3 contracts we're going to do here. And again, we're going to put this in our trading a smaller account. And sometimes you'll see these little notices here as far as the red goes. And basically this one's saying, if we're trying to get out of the trade, and sometimes liquidity can vary, they may substitute it with a limit order rather than a market order. Great. Okay. That is just fine. That's helpful for a trader. So let's go ahead. Let's send that one in. Thank you, George, for letting me know. I had it backwards. I appreciate you letting me know. George and Dragon and a few others of you. Thank you so much. All right. Let's look at something else here. Let's look at somewhere you might be familiar with. Walmart. All right. Walmart right now is kind of been similar to what the SPX has been doing, moving a little bit more sideways. But it's kind of interesting because I could connect here and we could say, well, only if my icon changed. Let's grab this. We could maybe connect these tops, but if we had it here, kind of looks like maybe it's trying to break out of it. How I was actually looking at this more so was the idea that it came down, it found support, and it's just kind of still sitting at support. And so maybe we could sell something that is below, right? Kind of this support area. This was old resistance, about 95, kind of acting as new support here. And it's just a buck above that, okay? So is it moving a lot? Not really. What's its ATR? Its ATR right now is 2, okay? Meaning its high to its low is a range of 2. And if we come over and consult the beta, what's this beta? This beta is 67. So is it as volatile as an average stock in the S&P 500? It's not. Is that a bad thing? Not necessarily. You know, when we look at that beta, we get an idea, are we on the wild adult roller coaster? You know, like with HIMSS, it's more than 2 points. And on this one, 67, then it's lower than what the S&P is doing. Makes it, you're more on the kiddie coaster. And again, here, we're seeing the implied volatility priced into the options is on that lower range of things. Okay, so what could we consider? We could consider doing a spread here. We could do a selling spread. We could do a buying spread. Looking at the open interest, look how lovely that is. Yeah, thousands of contracts and narrow bid-ask spreads. We love to see that. On this one, it could go either way because implied volatility is lower and the options are not super expensive. We're going to go to the buy side of things, but we're not going to buy something outright. We're going to do it as a vertical. Okay, so we're going to come at the money is this 97.50, and we're just going to say buy vertical, and it's going to put it at about $1.50 wide. And that's just kind of what the next strike price is. If you wanted it to be a little further apart, require the stock to do a little bit more, you could. This is actually not too bad here. Let's see what it would do. This might be a little bit on the low side as if we go out and look at the percentage here. Well, maybe not so bad. Okay, let's just look here. If we have $1.50 minus, it's giving us, I thought it was 29 cents. Now it's down to 19. It's basically saying what we have to gain is 131 and what we would be paying is about 20. Okay, that's going to be enormous as far as that goes. Let's come here. It wouldn't require the stock to move that much, right? 97.50. Is it 90? It's 98.50. 98 flat. From 95.5 to 98 flat. Where's 98? Kind of up towards the top range where it's kind of been hanging out. Now, does that mean it has to move a lot? Not really. Okay. But if we wanted to, because of the sideways action, I'm actually going to change my mind here. Let's do a short put vertical. I think we can do different strikes than what we're doing in a different class. So let's delete that. And the original strikes I'd selected, there was a 96.95. Let's move up here. 96 is about a 30-something delta. Sometimes traders like to target a 30-something delta or 40-something delta, right? So let's go 96.95 here. Same thing, we've got lots of open interest and a nice narrow bid-ask spread. We're only going to have $1 strike price difference here. So our gain here, I kind of like that 27 better. Let's put it back at 20. Let's put it at 26. It's wiggling around quite a bit there. We could probably get filled at 26. So that would be our max gain divided by our max theoretical loss of 74.74. It gives us about a 35% return with about 21 days left. So a lot of traders might like that. If you want to be more conservative, you'd go further out of the money. All right. Let's go ahead here. Let's figure out how many contracts we could do. Well, if 74 is our risk, and let's maybe say $500 is the max we want to risk, divide that by 74. That says, hey, if you want, you could do 6 contracts. Okay, you could do 6 or less. We're going to put this at 6. And we're going to put in an exit order to get out if we get a chunk. We get a chunk of that premium, okay? So we'll do a first trigger sequential. We're going to create an opposite order here. We don't want to analyze it. We just want to create it. There we go. And if we get, I'm going to go with 60. No, let's go with 70%. If we can get 70% of that 26 cents, then we'd say, go buy it back at 18. Now, that's not right. Actually, I take that back. If we captured 70%, there's only 30% left, okay? So 0.26 times 0.3 is about 7 cents. Would want to go buy it back at 7 cents. Well, just one period there. And we'll go ahead. We're going to make that a good till canceled. What does the stock need to do? We would love for it to stay above 96. It's at like 97, almost 98. So it's got quite a bit of leeway there. It can go sideways. It can drop down. We don't want it to drop down super far. Okay, we just would love for it to do that. And even if it goes a little bit below that, it doesn't mean the trade's not going to work out for us. Okay, we're going to go ahead. We're going to put that in to our trading a smaller account. Now, yesterday I did teach our short vertical class, and we talked about that credit spreads like this Walmart is a trade of patience. We kind of need to give it a little bit of time. Okay, so if you're interested in maybe following a particular strategy like short verticals, you might want to check out that playlist, and it's easy to do after you've become a subscriber. So down in the bottom right, some of you might not have clicked on that yet, that blue YouTube logo that says subscribe. But when you do, it makes it so much easier to find our content. Okay, you can come over here. You can see, I'm going to actually refresh this because typically it's going to show us what's going on right now. And you can join the class live from there if you want to. Shows you what some of the recent classes have been. And then if you want, you can see some of our new short videos. We've got a few of those out here. Scott actually did several of these videos talking about, average ranges or average moving averages that you might consider using for different purposes. And then we've got some in here with some candlestick action as well. Now, we have a new post that I want to point out to you, and that is on the new post, it is showing you our schedule kind of at a glance in a week. A lot of you spend a lot of time out on YouTube, and so this allows you to see the whole schedule, what's coming up for the whole week, who regularly teaches, and sometimes we have substitutes like today, who regularly teaches it, so you can kind of go and map out what you want to do for the week. I think this is going to help a lot of you find the sessions that you're really interested in tracking with. All right. Now, George says, are these typically defined risk trades and you size at your max loss? Some people might. Okay. I think you're helping Alex out there. Some people will say, I don't need to get every penny out of my spread. I just want a chunk of it. I'm not going to be greedy, but if I get a good chunk of it, then you might want to just take your profits and move on, because at that point, you're actually risking a tiny bit, or rather you're risking a big bit to just gain a few more pennies out of your spread. Okay, so that's why we might consider doing that if we get a chunk of it. Okay, so just as a reminder, if you haven't subscribed, go ahead and do that. If you'd like to follow me, I'd love to see you there. I'm at Connie Hill CS. And then the last reminder here is, if you wouldn't mind, fill out that survey for us. We love hearing your feedback. We want to know what you think. Our managers want to know. Scott wants to know. All right. And so if you fill it out, I promise I will read it. And the comments you share that would like to go to Barb, I absolutely will share that with Barb as well. All right, you guys, we took a look at the markets. We practiced some trades, kind of a variety of trades based on what we were seeing in the markets, as well as how those stocks were moving. We put on a long call vertical with HIMS that was pretty aggressive and not as likely to do in this class, or not as common. We did Walmart. We also did that last trade there. We did Walmart, and then we did MO as well. All right, you guys, appreciate you being here. Coming up next, I forgot to check who was coming up next here. So I'm going to go back out to here and hit back on my arrow. And I go to the home, and coming up next should be Advanced Charting Techniques with Kevin. That's what's going on next. So take a break, get a drink of water, come on back. We'll have advanced charting right at the top of the hour. Hey, thanks everyone. Have a good day. Bye-bye.